G'day folks, Jim here from Orchard Forex with a weekly outlook for the 29th of June through to the 3rd of July. Well, stocks were the main mover on Friday to end the week, down around 2.5% in a coronavirus-inspired move as new cases reach ever more concerning numbers, particularly in the US. So stocks had a tough day. The FX markets were generally pretty much sideways. I think the dollar index, the DXY, ended up about 0.1%. The biggest mover was sterling. Cable's down around a big figure. We'll go and have a look at that in a minute. And that as repositioning takes place ahead of the upcoming Brexit talks that are due to resume next week. Gold finished a little bit higher. It had a pretty spiky session, but it did finish higher. And it does look good in the short term. We'll go and have a look at the charts there. Oil chopped around. It did actually lose a couple of percent and was down 3%. Over the course of the week because of fears of diminishing demand while the pandemic continues. As far as the trend table goes, we'll go and have a look at that. And as you can see, to start the week, we'll start with the stock markets. The ones that I follow, but in particular the Standard & Poor's and the ASX, both look as though they're going to remain pretty heavy for the coming session. So I'd rather be trading those from the short side. And sterling is the only currency really that looks to have anything major going on. Euro might be looking a little bit heavy, but it's sitting above decent support. Elsewhere, it all looks a bit neutral on Monday morning. The dollar index, as I say, looks a little bit constructive, maybe turning a little bit higher, but I wouldn't get too excited about it. And as far as the crosses go, well, there's not an awful lot going on there, except for sterling weakness shines through again. Euro sterling looks bid. Sterling Aussie looks a little bit heavy, but nothing to get too excited about. We'll have a quick look at the upcoming weekly calendar. Now it's going to thin out towards the end of the week as the states prepare to go on holiday for the July the 4th Independence Day holiday. That's on Saturday, but I think Friday will be pretty much a non-event for the US session, which means that we've got the non-farm payrolls coming through on Thursday. We'll get to that in a second. Today, Monday, sees really not an awful lot. We've got the German CPI coming out, and then later on the US pending home sales, which have been hugely volatile recently, as you can see. This month of May, expecting from last month down 21% to this month a rise of 20%. So very volatile, hard to work out what's going on there, but they're not going to be particularly good numbers, I don't think. The Dallas manufacturing index is also coming out later on Monday. Tuesday we got the Chinese manufacturing PMIs. They'll be closely watched. There's a speech by the RBA Deputy Governor and private sector credit from Australia. UK domestic the GDP, but most importantly later in the day, well, we've got the EU CPI, but then later on in the day we've got Jerome Powell and US Treasury Secretary Mnuchin both speaking. So I think if we're going to see any volatility ahead of the non-farm payrolls, it's going to come around to what these guys have to say. Okay, so Wednesday starts with the Japanese second quarter Tankan. That may provide a bit of movement in the yen, but generally Wednesday is going to be about the manufacturing PMIs, which come out throughout the course of the session, ending with the ISM figures and prices paid late in the day. We've also got the FOMC minutes on Wednesday, as well as the ADP private employment numbers, which that's on Wednesday. We're expected to show an increase of 3.5 million jobs as opposed to the previous month, which was a loss of 2.7 million. And then on Thursday, of course, we get the main event of the week, the US numbers, the official employment rate. The market's expected to have added another 3 million jobs in June, which come on top of the 2.5 million that we saw in May, this number here. That would still leave the headline unemployment rate though at 12.2%. So it's going to be important that any bounce in the jobs numbers doesn't lose momentum, and a soft figure could undermine confidence in the recovery and spark another sell-off in the stock markets. So that's about it for Thursday, and then on Friday we finish up. It's a fairly thin day, but we start with the services and composite PMIs out of Australia, and basically just go through till the end of Europe. There's not very much out of the States at all, and then of course it's Independence Day on Saturday. Right, so we'll go and have a look at the charts. Okay, so we'll start off with the euro. This is a 4-hour chart. I'll just go quickly through the FX pairs. There's not an awful lot going on. As you can see, the euro did not do an awful lot on Friday. Here's a 1-hour chart. It pretty much moves sideways, sticking close to the 100 and 200-hour moving averages. Now, the hourlies aren't showing an awful lot of momentum. Neither the 4 hourlies. We are sitting above this support, but and I do think we can probably see a test of 112 again. 112.90, 111.95 was the low on Friday, and then down here we get this FIBO support and previous low down around 111.70. We need a break of that to push lower. I'm not sure we're going to see that today. Having said that, the dailies do still look heavy, and eventually I am looking for a run back down below here, and maybe an eventual test of this 200-day moving average, but that appears some way off, and we'd have to see something to give the US dollar a decent run higher, and I'm not quite sure where that's coming from at the moment. So more choppy trade, really, I think. The only dollar yen, we'll just have a quick look at that. That's much the same, not providing us with any real information. But sterling did see a sell-off on Friday. It came off about 100 points from its high up to 124.30 down to low of 123.13, 14, something like that. Now the hourlies do look heavy. 4 hourlies might be building some downside momentum, and of course the dailies do look a bit heavy as well. Now the 4 hourlies, we have closed below the 61.8% FIBO support, but we are sitting on 61.8% of this rally here, but we're sitting on the 50% pivot of this whole move, which has really been a bit of a magnet for the last, well, how long is this? This is a 4-hour chart. That's going back to early March. So I don't think we're going to see a huge move while the dollar's just chopping around. But if anything, I do think we're going to test the downside, because I don't think the Brexit talks, which are supposed to resume this week, they're not going to be easy for either side. So if anything, I think I'll probably look at euro sterling rather than sterling dollar. Just have a quick look at euro sterling. Okay, so here we have a 4-hour chart of the cross euro sterling, and we're sitting on the 50% FIBO pivot of this move down from early March. Now the 4-hour charts aren't really showing us a great deal. Possibly turning to point a little bit higher. The hourlies look okay, but they're getting a little bit toppish, so a bit of a pullback would not surprise. But the dailies do look as though they're building momentum, and if we can take out this level where we're currently sitting, then we can possibly. There doesn't seem to be an awful lot to stop it heading up towards this sort of 91.80, so 100 points on the top side perhaps. So just worth watching. I prefer to be a buyer of dips, and we'll probably keep a stop loss just under 0.9. So going forward to look at the stock markets, none of the other crosses are particularly interesting, so we'll go straight through to the stocks. Okay, so here we've got a daily S&P chart, and the theme is that basically we've broken back down to the support we spoke about last week, down between 29.80 and sort of 3,000. We've broken below the 200-day moving average, but we're sitting above the FIBO support of the rally up from February lows. If we do break below that, I suspect we're probably heading down towards this sort of 29, 10, 20 level. Now the dailies do look heavy to me, and the 4 hourlies also point lower. So a test of this level would not surprise me, and possibly come back down to look at this level here eventually, sort of 29.35, and below that we had the 100-day moving average of 29.10, I think it was. So I think that's the way of it. I'd be selling rallies for the time being, particularly as the coronavirus thing seems to be building up rather than disappearing. So I'd definitely rather be short the stock market. But the weeklies, has to be noted, still seem to have some upside momentum. I wouldn't discount rallies. You know, if we get to a sudden slowdown in the pandemic, confidence will come back quickly, and we'll see a spike higher. But for the time being, I do prefer to sell into strength. The same applies really to the ASX. We'll go forward and have a look at that. Once again, we're sitting on FIBO support here. Had a bit of a tough session late in the day in the States, so closed at 57.50 and a break of this FIBO support. The 4 hourlies are not telling us a great deal. The momentum is really driven by the daily chart. Now we are sitting on this 100-day moving average as well, so that's going to provide support early in the week, but a break, as I say, of this level will bring us back down to these previous lows down around here, so 5700, and eventually back possibly to 5640. The hourly charts for the start on Monday looking a little bit heavy, so I think we can possibly see a run down of this or 57 figure 15 level. I would probably be looking to day trade that, but certainly if we saw a rally to sort of 57.80 or so on Monday, I'd be looking to sell into it. I'd probably keep stop losses now. Well, that's a bit of far away, 5900. I'll probably keep the stop above this level here, 58.70. Let's have a look at gold. Now, gold, it had a spiky session on Friday. It had a very nasty $15 sell-off, but that very quickly recovered. And we closed at 17.70. And it does look to me as though we could see a run back to these highs, 17.85 that we saw last week, and possibly eventually to 1800, where we haven't been. We need to go right out to the weeklies to look at that, and we haven't been here since 2012, September 2012. So that's going to be a big level to try and crack. The weeklies, a little bit non-committal. The RSIs are kind of running out of steam, but we could see a test higher. I do think we'll probably see a test of this at 1800 just to see what's up there, if nothing else. But do note that the daily charts really are showing some bearish divergence, so I'd be a bit wary of being caught long at the top up here. Finally, we'll go and have a quick look at oil. Right, this is West Texas Intermediate, and having touched that resistance level that I spoke about last week, and well, last couple of weeks really, it has chopped around. It's ended about 3% down on the week actually, and it does look a little bit heavy if anything, but I think we're probably in a $35 to $40 range for the time being, and eventually I think we break to the top side, but that's going to be some way off. The 4-hour charts aren't really telling us anything, but this resistance level, to me, it remains pretty strong, and I don't think we're likely to break through there anytime soon, particularly with the coronavirus news that's spreading and the concern about an economic slowdown. But the daily is also pointing lower. So as I say, 35 to 40, I think at the moment is the range. Trade that. But I still like the look of the weeklies. And eventually, as I've said before, if and when we can break through this sort of 40, 43 level, I think we're then probably heading higher to 50, 55, but that remains some way off. Anyway, we'll leave it there for now. Thanks for watching, and if there's any major developments during the week, I'll put up a daily video, but otherwise I'll do another weekly outlook next week. Cheers, thanks for now.